Good morning, everyone, or afternoon, or whenever you are listening to this. I'm Vince Lancy, and this is the Hartnett Flow Show walkthrough. If you're not familiar, here's a quick intro. On the left-hand side is the actual report. The yellow markings are just to denote charts and alerts for me to pull charts up for you. The right-hand side is the report, the key parts of it transposed with the charts next to them, making it a little bit easier to follow the train of thought. I will go back and forth during this. So, in summary, if you're learning how to read this, Hartnett's weekly report is presented here three ways. The video walkthrough with analytical comments are transcribed. The second way, Hartnett's main points are broken out below. That's on the right-hand side. And the original format is also provided at bottom. We also break out the slides if you just want to look at the charts, because there are copious amounts of them today. Today's is pretty intense, meaning he's close to actionable. I'll put it this way. If the Fed is close to actionable, then this is an actionable report. There are several ways that you can monitor these aside from just looking at the markets themselves. One of them is if you're a student of reading Hartnett, the more tables there are in his report, the closer he is to saying to pull a trigger. And there are more tables than usual in here, and they're all actually necessary. Also, uh, we're including this week a too long didn't read summary because, well, we're going to get into some deep historical Hartnett perspectives in this conversation. So we wanted to give you some bottom lines up top. So too long didn't read, followed by a background context of why Hartnett says sell the first rate cut. Now, we're doing the context because he's not explaining himself in the detail that you may be accustomed to in reading these things. But he has, through the body of his work over the last year or two, especially the last, say, between the beginning of 23 through the third quarter of 23, he really refined what's happening now. And he's not going to go back and spell it all out for you again. So we have the context in here. You're free to skip the background context portion if you like and go right to the report if you are a habitual reader of this stuff. Anyway, so we're going to read the too long, didn't read portion, the summary. We may read the background context for you. We're probably going to go right to the Hartnett's Flow Show after the too long didn't read. So let's start with that. Hartnett for the past year has been saying, despite what many others say, you sell the market after the first rate cut here. His reasons boiled down are this. In an environment with disinflationary tailwinds, you buy the first cut. In an environment with inflationary headwinds, you sell the first cut. He believes we are still in a secular environment where inflationary headwinds, for various reasons, are dominant. He believes, putting words in his mouth, we are in an anti-Goldilocks world now. For that reason, you sell the first cut. Hartnett for the past year has been saying, despite what others say, you should sell the market after the first cut here. Broadly speaking, his reasons go like this. In a deflationary, disinflationary, let's call it, Goldilocks tailwinds climate, rate cuts are permission to rally. In an environment with inflationary headwinds or anti-Goldilocks, you do not buy the first rate cut. The reasons he gives for this are data-based. This goes back to last year when he first said this. You can read that. So why does Hartnett think we are in an anti-Goldilocks situation? Again, that's not his phrase, it's ours. We're putting those words in his mouth. Well, The factors that he's gone over numerous times are geopolitical stress, domestic fiscal largesse, commodity collateral shortages, that's picking up where Zoltan left off, less globalization, more mercantilism, and general policies, that's political, right? Reinforcing those as opposed to easing those factors are key to informing his opinion. He doesn't have an opinion, set it in stone and move on. He's been looking at these factors for the last year. In fact, he has been picking up where Zoltan left off since late 22. So for our part, we have been very keen on his work the past 2 years since Zoltan went MIA behind a $30,000 paywall and cataloged it in great detail here, not just for subscribers, but for our own portfolio management. Here is the full report. Now that we've gotten that out of the way or in front of you for some perspective or context, we can just read through this without making too many extemporaneous comments. Here we go. Scores on the doors, 31.3%, gold 17.5%, stocks 13.4%, oil 6.5%, high yield bonds 4.8%, commodities 3.9%, cash 3.1%, US dollar 3%, IG bonds 1.7%, government bonds minus 1.9% year to date. Zeitgeists. People underestimate how much lower rates may need to go to stimulate a weak economy no longer juiced by government spending. We will comment on this. This actually answers a question that we had. One of the things that he had been saying is the fiscal largesse underpins the strength of the economy. And one of the points he made about this is, well, you'll notice that if this is what's driving the economy, then GDP may just not be real. It may just be notional, meaning most of the GDP is inflationary. And the tell for that would be when the earnings came out. Well, the earnings are coming out now. Now, how does this tie with what's just said here? Well, if the election is split, in his opinion and ours, if the election is split, meaning, say, Trump wins and they don't get the Congress back, then you will probably see split political decisions, which means you won't have the stimulus that you want. Look, if they don't keep stimulating the economy, then 25 basis points aren't going to cut it. It's 50, it's 75, it's 100. And in fact, several banks are saying that. Now, I know that they're just front running to get out of their positions, but they're also economically right when they say that the neutral rate for us right now may be as low as 3.5%. Okay, so in an actionable statement, hey, 25 basis points ain't going to cut it if the government's not spending money anymore. Okay, moving on. The Price is Right. Government spending minus 6.6% on a 12-month rolling. Chart 3, you can see that. 5-year U.S. Treasury yield down 90 basis points in the past 3 months. 14-month high for defensive utility versus cyclical trannies. Weaker macro means ABB trade reversal deepens. Relative positive distressed leverage, U.S. Treasuries, utilities, small caps, REITs, Japan yen, and distressed duration, biotech. Summarizing this, as U.S. government spending drops, the bond selling reverses even harder. So bonds are a buy. Recessionary stock plays are a buy, meaning stocks that will do better from the Fed easing and stocks that will not do as well from the Fed easing. So you would sell big tech and you would buy REITs and small caps. That's a summary of that. Tail of the tape. Central banks cutting fastest pace since August 2020. Bank of America says 56 global cuts in the second half of 24, U.S. corporate bonds best tell whether cutting into soft or hard landing. We say harder landing, thus sell the first cut. Key credit spreads that would signal harder landing would be the CDX, IG greater than 60 basis points, now 55. Footnote, that was about 50 last week. That is important to him. The CDX high yield versus 375 basis points, now 348. I don't think he had mentioned that last week. Chart 4, he tends to monitor for part of his macro the global trend in cut. So emerging markets will cut sometimes, usually first, and then developed markets will cut afterwards. And also he monitors hiking as well. In this case, he's saying that we are on the rally in cuts. So there you go. The biggest picture: July U.S. ISM was weak, 46.8. Only other period ISM was less than 50 for a long time without negative payroll was 84.86. Overvalued U.S. dollar, chart 2. Okay. July payrolls are greater than, if July payrolls are greater than 200,000, consensus stays soft landing. But if under 125,000, then the 10-year is heading to 3.5%. Summary of that is, before payrolls came out on Friday, he's saying if payrolls came out over 200 grand, then go back to the soft landing mindset. If we come in under 125 grand, then you better start thinking harder landing, and that makes stocks in general vulnerable. It makes big tech stocks even more vulnerable, and it makes the 10-year yield a buy. Mind you, this was put out Thursday, not Friday. So he's on the money here. Also, he's saying that generally speaking, when the ISM is this weak, under 50% for a long time without negative payroll, well, I'm sorry, in general, when the ISM is under 50%, you have higher unemployment, period. And that's pretty simple if you think about it. If manufacturers aren't making stuff, then and people aren't buying stuff, which is what's happening now, then people are going to start getting laid off, right? These are reasonably correlated, reliable, predictable tools that work when there's no manipulation with monetary rates. Okay, so the exception for that was we had a weak ISM without negative payrolls between September of 84 and April of 86. During that time, he contends that the U.S. dollar was very strong, and that made unemployment stay where it was. All right, moving on to the next piece. You could see that in the chart there. Weekly flows, 14.6 billion two bonds, 8.9 billion two stocks, 0.8 billion two gold, 0.4 billion from crypto, 12.5 billion from cash. First of all, this is institutional. If you're wondering, I believe it's institutional. I could be wrong. Second of all, note this: money out of cash into bonds. That means people are starting to roll their T-bills into longer-term bonds. That's my opinion. They're also putting their money into stocks as well. Don't get me wrong. All right. But you're seeing the stock money is rotating as well. Money into gold, money out of crypto. Well, there you have it. Gold's been resilient in the face of dropping crypto, or let's put it this way, crypto has been weak in the face of rallying gold. I want you to go back to whether you think Bitcoin and crypto in general are monetary monitors for slop. They have a bifurcated personality, and I'm just throwing this out there. This is me talking. Crypto will start to go back to behaving like big tech until the Fed gets whatever's happening under control. Okay, because it is a leveraged asset. There is a lot of money in it. And now you got your grandma and grandpa, or people like me, putting money into crypto in ETFs. And believe me, when their NVIDIA drops, they're calling their broker saying, sell my crypto out too. That's just how it works. And I think we should be aware of that, that crypto will start getting abused because it's uh, mirroring tech. Warranted or not, that's what's going to happen. All right, flows to know. Treasuries, 13th week of inflows, 2.9 billion. Investment grade bonds, 40th week of inflows, 10.8 billion. High yield bonds, 5th week of inflows, 1.5 billion. China, 9th week of inflows, 4.8 billion. Again, that's money that's probably mostly going into bonds. Tech, largest inflow in 6 weeks, 3.6 billion. Utilities, largest inflow in 8 weeks. That's 0.6 billion. Make of it what you will. Bank of America private clients, we're going to skip that, except to just take a quick look for precious metals and gold. Here we go. Private clients are buying Japan. That's a mistake, in my opinion. Utilities, that's not a mistake. Municipals, probably not a mistake. Selling tips, well, it's not a mistake for the short term. Materials, not a mistake for the short term. All right, so see this here? This is, oh my God, we're going to have a recession. That's what that is. This, no idea what this is. It's probably people coming in late and saying, oh, Japan went up, maybe it'll go up more. I don't know. B of A bull and bear indicator drops to 6.6 from 6.9 on higher FMS cash, weaker credit technicals, worsening stock index breadth, offsetting bullish hedge fund positioning. All right. Now we get to the fresh meat, so to speak. And in this section and the other sections, especially this section, he is going back to that table that he did a year ago, and he's looking at how the market reacts under a cut. Goldilocks versus anti-Goldilocks. He goes further and looking at it in context of panic cuts, soft cuts, hard cuts. So let's do that. Okay. Getting a little bit more fine-tuned on selling the first rate cut. There are 12 occasions since 1970 that the Fed has cut rates for the, quote, first time. Table 1 illustrates 3 types of Fed cuts. All right. Before we read this, I want to take a closer look at this table. And you'll notice on the right, it does not render very well. He's using some gray writing there, maybe because of stuff like this. So I'm going to bring up this, and we're going to look at it together. Let's make it as big as we can. All right. First cut. There are 3 types of cuts. We'll read his words in a second. Soft landing, hard landing, crash, or credit event. Okay. So soft landing cut. October 84, July of 19, and July of 95. There was no recession during a soft landing cut. Mind you, we don't have too many soft landing cuts. We really don't. And we've really only had one since the great financial crisis, right? So we just don't have those. We have a lot more bubbles being inflated and collapsing. All right. He uses the 10-year yield, the 2s and 10s, and the S&P 500 as his monitors. Now, on hard landings, which we get a lot more of, okay? We get a lot more of, and those actually are split between Goldilocks and anti-Goldilocks, and I'll show you what I'm talking about. All right. In September of 73, hard landing. Stock market. We're focusing on the 3-month time frame here. September of 73, stocks dropped 9.9% after the first cut. That was during an anti-Goldilocks era. July of 74, stocks dropped 26% 3 months after the first cut. April of 1980, now this was stagflationary environment on the way out after massive rate hikes by Volcker. Okay, so you can call this coming out of the anti-Goldilocks era back then. Coming out of the inflationary era is probably how Hartnett would describe it. So April 1st, 1980, 12.5% up, right? Do you think we're in that type of an era now? Well, if you do, then you're long stocks. June 1st, 1981, down 7.1%. Also, this cut preceded the recession. Interesting, which is what I think we're looking at now. A cut that's, quote, preceding a recession if it happens. June 5th, 1989. Again, we're definitely out of the anti-Goldilocks era now. We're not worried about inflation anymore. The first cut was 12 months before a recession. Stocks went up 9.5%. January 3rd, 2001, first cut was post-dot-com crash, preceded recession. Ooh, stocks down 17.9%. September 8th, 2007, first cut preceded recession, stocks down 4.3%. Okay, an addendum to my own concepts. Look, in 23, when he went into this, he was very focused then on, are we in a secular inflationary or disinflationary era? And I think he's pretty much rested that we're in an inflationary era. Now he's saying, now that we've put that as a driver behind these sell the first rate cut concepts, he wants to look at, in this era, he's looking at, when we have hard landings, when did we cut? Meaning, did we cut before or after recession started? It's kind of interesting that he's doing it this way. So hard landings, this is what happens. All right. Crash or credit events. Well, that was 87. You know stocks are going to go up after a crash or credit event because they probably really cut it a lot. 1987, up 10.9%, and September 98, 18.4%. All right, so that's the data surrounding his descriptions. So let's read them now. Panic cuts are the Fed cutting in response to Wall Street crash or credit event, e.g. 1987 and 1998. Panic cuts equal risk on. S&P up 20% on average, 6 months post first cut, so long as Wall Street event not felt on Main Street. Right. So the Fed is cutting to cure Wall Street to prevent Main Street from feeling it. So if you get Wall Street stocks to stabilize, then people won't get fired. That's a panic event, right? For example, long-term capital 98 was not a panic event where Lehman in 08 was. Okay. So long as, et cetera, you got it. All right. Soft cuts. Fed cuts into a soft landing, e.g. 84, 95, and 19 are positive for stocks. S&P 500 up 10%, probably on average. And bonds, 10-year treasury yields down 56 basis points in 6 months after the first cut. All right. Hard cuts. Again, he's not focusing on the inflation versus disinflation, which was a main focus. I think he's pretty much resigned himself that we're in an inflationary environment, and now he's focusing on, he's getting very macro here. Hard cuts. Fed cuts into a hard landing. Examples, 1973, 1974, 1980, 81, 89, 01, and 07. They're negative for stocks in general, right? Some of them had good years. When the S&P was down, the S&P is down 6% in the 3 months following, and positive for bonds, 10-year yields down 38 basis points in 6 months, plus big yield curve steepening. Okay. Interesting. All right. So he's looking at the average here. We just went through the individual days. Let me take this as a package and paint a picture. Okay. In general, when the Fed cuts into a hard landing, stocks drop 6% in the first 3 months. And bonds, 10-year and further out, rally on an average of 38 basis points on the yield side for the next 6 months. Plus, there's a big yield curve steepening of 95 basis points for the 2s and 10s yield curve in 6 months after. Okay, so what does that mean? Number one, on average, stocks sell off in a hard landing. On average, bonds do well in a hard landing. That's easy enough to understand, right? Okay. Big flight to safety, hard landing, dogs and cats sleeping together, that type of stuff. This part here is a little bit less hard to understand, but I think it's forward looking. The yield curve steepens. Now you have bear steepenings and you have bull steepenings. Your bear steepening is when the yield curve in the back goes up, yields go up, and the fronts stay the same. Your bull steepening is the yield curve in the back stays the same and the fronts go down. Now, in this situation, I can tell you what this looks like. This is the long-term yield curve, right? The 10, 20, 30-year yields dropping because people are buying bonds. They're clamoring for bonds and to sell stocks. And this is also people buying short-term bonds at the same time at an even bigger rate because the Fed, they believe, is going to keep easing. So this is a forward-looking thing. The reaction in the 3 to 6 months following a Fed rate cut into a hard landing, on average, is an S&P 500 of down 6% in the first 3 months. And on average, it's a net positive for bonds for the 10-year on out as yields drop down 38 basis points. It's an even bigger positive for short-term bonds as people run into those because they're more cash friendly. And people run into those because they believe the Fed's going to cut even more. So you have a stock market that's, excuse my French, shitting the bed, people clamoring for bonds, but the bond yield curve telling you, hey, it could get better in the next 6 months after that, which would be interesting to look at. And I'm sure that he has looked at it because he comments on how we come out of these later on, meaning after the next cuts, after the second and third cuts. I believe that this driver starts to kick in. All right. We say, Hartnett says, sell the first cut as the hard landing risks are 11%, according to the latest BOA global FMS, clearly rising at a time of soft or strong no landing consensus, according to FMS. The chances of a hard landing as monitored by the market, not probabilities, but how the market views the probability are, only 11% chance of a hard landing and an 86% chance of a soft landing. That is what we talked about yesterday, a very crowded trade. If there is a soft landing, then there's really only 11% more people who have to buy, to simplify it. However, if there is a hard landing, then there's 86% people who have to sell. That's what he's talking about. When he talks about these surveys, he's really taking a poll of the mindset of the participants in the market. If only 11% think we're going to have a hard landing, well, maybe we won't have a hard landing. But if we do, this market can go a lot further to the downside than if we don't. Okay? Now here's probably the icing on the cake. What's the next chart? One very important difference in 2024 is the extreme degree to which risk assets have front-run Fed cuts. Stocks up 32% in the past 9 months versus the average of 2% in run-up to 12 occasions since 1970. Table 2. Okay, this is tailor-made for our analysis, what we've been talking about, and I'm very happy to see he sees it this way from a completely different angle. In summary, he's saying that the market has rallied so much in anticipation of this cut that there's really not a lot of upside left by historical measurements. Now, we would add this. People have been calling for a first rate cut since July of 23. And during that time, between July of 23 and today, the stock market has done nothing but rally. The market has been hoping for a rate cut for a year. And despite not getting one, it has found other reasons to rally. Now, I'm going to contend that part of that has been the fiscal spending and Yellen's manipulation of the bond market yield curve by doing what's, I guess, can be characterized as a stealth QE. Simply put, she instead of borrowing at the 10-year level, she's borrowing at the 2-year level. And in the process, she kept bonds low artificially. And in doing so, she kept money more biased towards going in the stock market. But back to Hartnett's point. Hartnett's point is stocks have really, really, really rallied in anticipation of this rate cut. My point is they've had a year to do it, and they've been relentlessly rallying. Okay? So there's an average of 2% in run-up to 12 occasions since 1970. So either he's wrong or he's right. And I would tend to believe in this situation he's right, because we have had such a long time for everyone. Look, not only do we have a crowded trade, 86% of the people are convinced we have a soft landing coming. We've had a year to do it. A year of people saying there's going to be a rate cut. A year, right? So it's kind of crazy. Now, can I give you the bull scenario on this? Yeah, I can. The stock market is rallying because it doesn't care about rate cuts. The stock market is rallying because we are fiscally controlling this market and we're retooling our economy for manufacturing. And that's all true. But Hartnett is no longer in the Zoltan area. He's in the macro area. And he's saying, listen, these correlations don't break, meaning the labor market and the housing market. And when these correlations trigger, you're going to have at least a back off in this rally. And again, he put this out before Friday. And let's face it, Friday was a sell-off that came simultaneously with banks saying there will be bigger rate cuts. It's kind of crazy, but he's on the money. You know what? Let's pull up that table because it's really here. Here, see that? I mean, you can't see that. So here we go. All right. The run up to the first rate cut, as opposed to what the market does after the first rate cut. All right. We'll focus on the hard landing. That was an accident. There we go. In the run up to the first rate cut in a hard landing scenario, mind you, if we are in a hard landing scenario, it looks to me like on average, the 9 months running up to it are pretty much flat in a hard landing scenario. In a soft landing scenario, the months running up to it are 10.5%. By the way, let's focus on the soft landing. Let's assume that it's not a hard landing. This is basically Hartnett saying, if I'm wrong, I'm not that wrong, right? If we're in a soft landing scenario and the Fed has their first cut and he's wrong, we're not in a hard landing scenario, then on average, the S&P 500 goes up 10.5%, right? But look at the volatility of it. 22% in the months leading up to it, right? In 95, minus 0.8% in the months leading up to it in 84, and up 9.9% in the months leading up to it in 19. Now, do you think we're going to have a soft landing or not? And if you do think we're going to have a soft landing, well, you're probably not going to see that much more of a rally, is his contention. If we have a hard landing, you will see no rally at all. So he's combining soft and hard landing rationalizations. One is a put, the other is a call. All right, back to the report. So again, I just want to recap this. The very important difference in 2024 is the extreme degree to which risk assets have front run Fed cuts. 32% in 9 months. That's that's 20% better than the average of soft landing rallies. So you can make the case if you're a bull, this is going to be no landing. Well, did stocks act like it was no landing on Friday? If it is a no landing, then Hartnett's going to have to come back and say, shit, I was wrong. It was a no landing. Shit, I was wrong. The ISM weakening does not mean people will get fired, but we know people are getting fired. Intel just proved that. They're going to fire 10,000 people. They're going to cut their dividend and they're going to stop spending on future growth for chips. That's recession. That's not no landing. And it doesn't seem like a soft landing. Anyway, I'm just bolstering Hartnett's case. If he's wrong, it is just bizarre based on what happened with Intel. All right, next on credit and small cap. Okay, so this is significant. Credit and small cap, he contends, of all the reasons to think we're going to have a soft landing, credit and small cap are the point of the spear. If you say we're going to have a soft landing, you point to this and you say, this is why we're going to have a soft landing. And so let me read what he says here. U.S. high yields are the best performing fixed income market year to date, annualizing a 7.4% return. Leveraged companies are refinancing at lower cost of debt, e.g., $2 billion Royal Caribbean debt refinance at 6% from 8%. Animal spirits and credit shown by big rise in U.S. high yield issuance in 24, up from 176 billion in 23 and 102 billion in 22. Chart 5, you can see that. And last month, no new defaults across high yields and loan markets. First time in the past 2 years. High yields are the king of the soft landing, and the ongoing resilience of credit remains the number one reason why soft landing is the conventional wisdom. There you have it. So that's his, if I'm wrong, this is why I'm wrong. Let's see what else he says about that. So he's pointing to a potential contradiction here. Small cap, by contrast, has been king of the hard landing. Historically, when high yield outperforms investment grade bonds, small cap outperforms large cap big time. Chart 6. Total opposite we've experienced the past 2 years, meaning high yields have outperformed investment grade bonds, but small caps have been getting crushed compared to big caps. Let's see what he means. What does that mean? What does he think that implies? Total opposite past 2 years. H2 reversal of ABB trade. So if the second half of the year is reversal of the ABB trade and government bonds are going to be bought, then lower government bond yields in the next few quarters indicate small beats large, and 2024 is entry point into trade. Perfect entry point, clearly delayed if high yield spreads widen, signaling harder landing. Okay. Okay. If high yields are outperforming, historically speaking, and small caps are not outperforming, then he's looking at a timeline or a lagging continuum where he believes that if in the second half of the year bonds rally as they did, Friday is an example of what he's talking about, then lower government bond yields in the next few quarters indicate small beats large. Okay. If government bond yields stay low, then small cap will outperform large. And 2024 is the entry point into trade. Now, this is a more finer point on the concept of, hey, If the stock market's going to drop and everyone's going to buy bonds, then small cap's going to outperform large cap on the way down. And you might have an even harder landing because of the delay in high yield. So look at it as one of those alligator jaw things. High yields are telling you everything is great, and small caps are telling you everything is bad. And those two things don't usually move like that. So who will win, high yields or small caps? Well, for the last year, it's been high yields. What will happen for the next year? He's betting that it's going to be small caps, meaning they'll outperform bigger stocks, indicating a harder landing. All right. Mouthful. Admittedly, there may be some things I'm missing there, some nuances, but if you know stocks, you know what to look for. Okay, so now we get into actual profits, and these matter to him because with a strong GDP and weak earnings, you're basically getting a fake economy. And so the economy is not, the GDP is a leading indicator, and the earnings are the actual manifestation of the GDP. So if the earnings are weak, then a GDP was fluff. And when you think about it, with the earnings being weak now and with unemployment being probably cooked low for the last year, you get your thing. So here we go. On profits, Asian export growth to decelerate from 10% to less than 4% by year end. Chart 7, I have that up. Weaker global manufacturing PMIs, CISM, steady China financial conditions, lagged impact of U.S. yield curve reversion. BOA, global earnings per share model of global profit expectations, i.e., 12-month forward earnings per share, says earnings per share forecast to decelerate from 11% in July 24 to 5% in December 28. Let's take the first part of that in English. China ain't making stuff to sell because they ain't exporting stuff. And we ain't buying stuff. So as much as people want to say that the BRICS will replace us, and they probably will on the purchasing side eventually, they're not doing it overnight. And that shows that the economy's profits are going to drop, not just China, but the world. Now, moving to the second one. The second piece is kind of a finer point on something he'd been saying for a while, which I just kind of paraphrased, is that he thinks earnings per share are going to drop. Earnings are going to not confirm what GDP has been saying for the last year. So what does he say here? BOA global earnings per share model of global profit expectations is forecasts that earnings per share will decelerate from plus 11.7 year over year to 5% December 24. And there's chart 8. A little blurry when I copy paste these. I wonder if that's intentional. Probably Substack. So there you go. He's saying these things matter a lot. So, is it going to go back up? Probably not. All right. The infamous Sahm rule, infamous because people think that she's uh, a bureaucrat with an indicator that's mediocre at best, named after her, but he's not going to say that. The infamous Sahm rule triggered if the unemployment rate rises to 4.3% in the second half of 24. Quick comment on that. Oh, that's what came out yesterday. 4.25% rounding up to 4.3%. You will get pushback from bulls saying that that was because of the hurricane, and it will, adjusted for that, go down to 4.1%. And that may be true. But when you see Intel saying we're going to fire everyone and their mother and other companies following suit, it ain't going to go back to 4.3%. All right. So that's the key, right? Everybody loves the Sahm rule because it's created by a Fed employee, and therefore that makes it accepted, have pedigree, and is probably not a bad indicator. All right. So the infamous Sahm rule has either preceded or coincided with every U.S. recession since 1950. Okay, table 3, triggering of Sahm rule indicator coincides with recession. The Sahm rule, I believe, has to go over 0.5, 0.5 or higher. I'm not sure. Oh, I'm sorry. The sum rule is indicated, right? Okay, that's a coefficient. So there you go. There's your sum rule greater than 40, greater than 50, 50 unemployment rate ticks up. There you have it. Most of these seem facile, but if you look at the more recent ones, it's kind of spot on, March '01, December '07, 2020. The earlier ones are early, right? You can say that they might not be as accurate, but none of them contradict what she's saying or what this tool says. Chart 9. Oh, here we go. A little bit more visual. Some rule triggered if unemployment rate rises to 4.3% in second half of 2024. Okay. Well, that's what happened, right? So the sum rule greater than 0.5 is basically here. Let me make this clear for you. The sum rule is currently at 0.4. Okay. If the unemployment reverse engineering, if the unemployment rate goes to 4.3%, which it did on Friday, then the sum rule goes to 0.5 or higher. And that's it. That's basically it. That's the factor that they were waiting for, and that's what they have. All right, so I'll leave that up there. Key for investors to watch is housing, most rate sensitive, despite drop in yields, mortgage refi activity near 23-year lows. Okay. This is extremely important, I believe. And it's the thing that if you're on the fence, whether we're going to have a recession or not, should push you into the recession camp. And I'll explain why. First off, and this comes from a Goldfix founder who happens to be an executive in the real estate market, focusing on high-end housing. He oversees the exodus from cities, from blue cities to red suburbs. He's right there at he's right on the intersection of that, as well as commercial real estate, primarily in the mall area. So commercial real estate, not housing, not offices, but malls. So he's seen it all. He's got his finger on the pulse here. And what he said to me when I was saying recession, recession, recession because of the yield curve, he said, well, as long as housing is doing fine, there will not be a recession. And the finer point of it was because they keep this market, this economy is construction driven right now. Nobody is firing people hanging drywall, and that won't happen because there is his phrase is a bright flight out of blue cities into suburbs. Now, I'll put a fine point on that. In cities, housing prices may be going up, but the high end housing prices were going down. Okay, as wealthy people who don't live in walled communities are saying, you know what, this is bullshit. I'm not going to keep living where I have to worry about going to a store and my wife or my daughter or myself getting mugged. And so they're moving to affluent suburbs. Housing construction boomed in his field, right? So uh, the high end New York City Upper East Side house, screw that. I'm out of here. I'm moving to Florida. I'm moving to Greenwich. I'm out, right? Right. Now, if you're lower middle income, you're trapped. Meanwhile, your house is going up in price, if not in value, because of inflation, because rents are going up, because immigrants are taking up more space. So you have the whole middle class getting squeezed, and you have the higher end leaving. So you have an exodus. Now, that background aside, continuing on this concept, in addition to what I just said, that was a reason for the market to do well. But very recently, you finally have seen a backing off of this. Existing houses are now finally higher in price on average than new manufacturing. So I have to talk to uh, our friend, our founder subscriber, but I'm going to guess that the high end housing is probably cooling off a little bit. It's not in recession by any means, but cooling off is enough when you've been this hot for this long. Now, on top of that, and this is something that I've observed, is that even as the bond market has softened, right? Even as the bond yields have softened a little bit, mortgage rates haven't come back down. You can't afford a house, number one. Number two, houses aren't coming on the market. Retired boomers are not going to sell to move to Florida if they can't afford to move to Florida. And so, therefore, even though the very wealthy are saying, screw my 3% mortgage, I'll go for a 6% mortgage, or you know what? I'll just buy cash in the suburbs. I don't care about a mortgage. The people that are 65 whose houses have appreciated a lot have these 3% mortgages that they will not give up. They won't. So they're there. And if they're not selling with mortgage rates at 5%, you have a problem. And the problem is a generation of people, middle to upper middle class, that are doing okay with 3% mortgages, they're locked into their houses. And I won't call it house rich, or maybe I could call it house poor. But the fact of the matter is, they're better off staying where they are, period. And because they're better off staying where they are, you have less supply of affordable housing on the market, and you have higher mortgages that are not coming down, because that's consistent with, in my opinion, the Fed's need to keep services inflation going down. And services inflation is very tied to housing costs. They want this. All right. So, bottom line here, I believe housing turning confirms everything that's going on right now. If I was having a conversation with Goldfix founder, my friend, we'll call him Bond. He's a big fan of AC/DC, so he's a Bon Scott fan. If Bond says, Vince, I'm still selling houses like they're pancakes or hotcakes, he's prone to uh, humorous old style, phrasing, then I would say, you know what, fine. But he hasn't said that recently. And I'll call him again after this, but I don't think I have to. I think he's going to agree with me, but we'll see. All right, moving on. So bottom line here is profits ain't coming back, and housing is telling you that we're rolling over. All recessions are led by weaker housing, period. Even if that's not the reason the economy did well, weaker housing leads recessions. People don't feel as rich, the wealth effect drops, and they stop buying stocks. They live in their house, they see it every day. All right, finally, on Japan, China, and oil. Okay, on Japan, Hartnett drills down into something that may not be obvious, but let me just start with the broad stroke here. China is no longer interested in having deflation. They're interested in letting inflation rear its ugly head and simultaneously fighting it, which means they're selling bonds and supporting the yen, which means recession, which means stocks sell off. That's it. That's the gist of what's going on. Now, this chart here, chart 10, is not about that. This chart here, however, is very helpful in understanding in Japan. We've said in the past in one of our, more academic conversations, that a steeper yield curve, while it may be good or bad for the stock market, bear steepening versus bull steepening, a steeper yield curve in general is always good for banks. All right, to make it clear, if banks are lending you money, if banks are borrowing money from you at 1%, and they're lending money further out on the yield curve at 10%, then they're making money. The steeper a yield curve is, generally speaking, there are exceptions, the more money banks make. So as yield curves steepen, financial companies, purely financial companies that have no asset risk, that have no physicality, do well. Okay. And so he's pointing out here that Japanese bank stocks are telling you that they're predicting a much steeper yield curve. So let's read that. I'm going to skip all that here because that's all about the yen. We all know about the yen now, right? All right. If the Nikkei, which has been massively boosted by weaker yen a year or two, again, can withstand a stronger yen, That's a true sign of a bull market. Watch Japanese banks up 42%, a sign that the trading of the strong Japan yen can continue. Then 10-year bond yields 45 basis points in Japan, plus 14 basis points in the US, minus 45 basis points in China. The baton of deflation well and truly handed off from Japan as to China. Whoa. Okay. All right. Hold on for a second. Okay. He's being a little contrarian here on Japan. All right. He's saying that, look, everything that I just said is true. Everything that's happening should be bearish for Japanese stocks. However, if the bank stocks can really, really key in on this steepening yield curve and outperform, then they will keep the economy going by lending money because they're making money, and the stock market might weather this storm. That's kind of a contrarian statement to make, but that's what Hartnett does. He doesn't just say, I agree. Okay, moving on to uh, uh, the China, US, Japan. Okay, let's pull chart 11 up. It's the fact that he doesn't put in connecting words and modifiers that makes you have to guess. But it's not really guessing if you've read enough of his stuff. All right. If the strong yen can continue, meaning if the Japanese stock market drops but doesn't get completely crushed, right? If banks do well, maybe the Japanese stock market does okay, and simultaneously you will see the strong Japan yen continue. If that happens, you will continue to see this 10-year yields up in Japan, 10-year yields up in the US, and 10-year yields already down in China lower. He says that if this continues, Japan yields up, US yields up steeper, right? And China yields stay down, then the baton of deflation well and truly has been handed off from Japan to China, as a 10-year China bond yield is at an all-time low of 2.12%. Okay, this is very bearish on China if it happens. What a lot of the neo-Keynesian, not even neo-Keynesian, but a lot of the macroeconomists have been saying for the last 2 years outside of the gold sphere has been this. China has a command economy, and that means they control their own economy, right? If China does not start consuming more, if China does not start buying stocks more, then they're going to run into the Japanification that Japan had. And so he's saying here that this is the first time he's saying this, right? That if this continues, you run a real risk of Japan literally taking that deflation baton and successfully handing it to China, which is fascinating because one of the things that China has held important, and people that are bullish on China have said, and Louis Gave was one of them, and I understood where he's coming from. He made a comment that look at China's stock market. China's stock market is very weak. Look at China's bond market. China's bond market is very strong. And that's the observation being that China's worried about the long term, not the short term. And their people aren't worried about the stock market. Their people are building a country. Very, very long-term minded. The stock market will take care of itself if the bond market is solid. And I subscribe to that, meaning you need a healthy bond market to make people eventually buy stocks. But to give the opposite side of that, I also noted, but I was aware of, but not necessarily in favor of, that maybe the Chinese were buying too much gold and not enough stocks, causing a deflationary crisis to be a bigger problem than it looks. Maybe circling back to the macro bears on China, maybe China needs to invest in itself a little more and not in their bonds, in their equities. Maybe China, having scared out all that foreign investment, is about to suffer a big hit because it is a global world, even though we're deglobalizing a lot. And China may have weathered a storm for very long. And, I'm kind of acknowledging what Brett Johnson's saying here, that China's not going to be able to sell uh, their Costco umbrellas to uh, uh, to the lower middle class in Saudi Arabia or Brazil. They're manufacturing at the same price they can in the U.S. So without the U.S. and with Japan, coming out of their deflationary crisis, that deflationary baton may have been passed. I say this being realistic because this could be one of the reasons that China has stopped publicly buying gold. Uh, although I believe it's also, at least in part, because they're making room for India, because we are headed into a BRICS multi-currency, multipolarity situation. But you have to consider this. What happens if China stops buying for real? What happens if it spreads to India and they stop buying for real? That's bad for gold. It's actually very deflationary worldwide, and it's bullish for gold. But because it's bullish for the dollar and gold, if you look at it that way, compared to stocks, let's say. But if you're China, you're selling gold to get the cash back to invest in your own companies. So my conclusion is you're probably going to see, if China does it right and China heeds the West's warnings, you're probably going to see China do what the US did in COVID, and that is they will do direct money. They will do more fiscal stimulus. China did not do as much fiscal stimulus as we did. And so we had raging inflation when they didn't. Well, now that our inflation is under control, maybe they're going to have raging deflation. And if they don't stimulate right away, possibly in the form of, literally stimulus checks, if they don't make Chinese people feel that money is easy to get, then Chinese people are not going to put money in stocks. And without foreign money, specifically Western money, if China doesn't invest in its own stocks, well, then China's got a problem. So I think that's really important with regards to gold. Okay, moving on. Okay, so China chart 11 is sending weak spread, descending, minus sending spread between China and Japan yield. Oh, it's sent. Sorry. China and Japan yields the lowest in 20 years. China equals weak global economy trade. Why oil prices soft despite ongoing economic risk. Number one tail risk and latest. Okay. We all rationalize here a little bit, and I don't think he's wrong. But you know what? Why are oil prices weak despite all these geopolitical risks? And this could be your answer. We're moving in towards a very deep global recession. Okay. And, oil is the number one tail risk, or being short oil is, I'm sorry, being oil going up is the number one ongoing geopolitical tail risk. However, oil's not going up. And so China maybe not be buying as much oil because we're not buying any uh, plastic toys. I'm sorry, I don't mean to be derisive, but to simplify it, we're not buying anything from China, and certainly they're not buying a lot of Chinese goods in Saudi Arabia that are expensive anyway. All right, so the summary of this would be Japan is in the process of getting out of its deflation, and so is and the U.S. is also in the process of inflating, but China's not budging. And if China's not budging, the manufacturer of the world is not budging, well, then you may have a bigger problem on hand, and that also could be oil. So China could drive us into recession. So China's not helping matters. Let's put it that way. That's pretty much it. After that is his charts. So we'll switch to the right-hand side here and focus on that. Chart 12. Geopolitical risks are high, overshadowed by weak macro. That's a statement about oil. Geopolitical risks are high. Gold is high. Why isn't oil high? Right? And he's saying maybe it's overshadowed by weak macro. All right, asset class, asset flows. Table 4, by the way, that's my cheat. I go to the asset class flows, and if it's table 1 or table 2, I know it's probably going to be a boring report. If it's table 4, then I know he's had some cool, potentially actionable tables to look at. All right, so global flows by asset class, commodities unchanged, institutional and client flows. Oh, wait a minute. Oh, I see. There we go. That's what we want. Uh, Commodities, money out of commodities at the institutional side, money out of gold and silver. Okay. What are we looking at here? What are we looking at here, Michael? Should I be worried? Private clients also sold precious metals, and yet he said money went into precious metals. What am I looking at here? We know they sold tips. They sold gold and silver, so they're selling everything. Look, forgetting what he says at the scores on the doors part, this is yuck. This is yuck. All right. Bull and bear indicator, not as bearish as it was, but that's an objective tool. He hasn't put his opinion on that tool. And there's the quilt. There's the slide decks. A lot of slides today. By the way, honorable mention. He has a chart. Wait, let me bring it back to this one. He has a chart he introduced a while ago, about a month ago, maybe a month or two ago. Let me find it. Sorry about your eyes there. There it is. There it is. See that one there? This was him monitoring the flows from BOA clients getting out of T-bills and putting it into bonds. Well, look at that. It's just starting. Now, can this go as high as that? I don't think so. Maybe it can. Who knows? Depends on where the yields are. We'd have to go back. But if you look at it for the last, say, 5 or 6 or 7 years, rarely do they have a lot of money in there. So it's the money coming out of here that matters. Where's it going? It's going to go into the T notes. They're not going to go into the yellow. They're going to go from here to here. And so we may be halfway through that. And in this part, you may actually see the acceleration of the 10-year going up, even while the T-bills rally. And that's a shit sure way of talking about a recession. Anyway, I'm Vince. This has been the Hartnett walkthrough. Sounds to me like he's saying sell the first rate cut, which also sounds to me like they're better clients, and people who follow Hartnett on the street probably started selling on Friday or maybe Thursday. Bank of America's clients probably sold on Thursday. He's basically saying we need a 50 basis point cut to at least stabilize this, to echo the other banks. All right, that's it. I'm Vince. See ya.